Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ryan Detrick, Senior Vice President and Chief Market Strategist at LPL Financial, for his initial take on the Fed rate hike, our first one since 2018, as well as we'll talk about inflation and possibly the recession word here. Ryan, great to see you as always. Welcome back to Trade Talks.
Thank you very much for having me, Jill. Appreciate it.
All right, you got it. Just after 2:30 p.m. Eastern, what were your thoughts around the initial reaction of the market to the rate hike?
Yeah, nothing too out of the ordinary. I guess we're going to have to wait for Q&A to see. I know a little sell-off, but honestly, it seems like the Fed just kind of did what was expected, right? 25 basis point hike. You look at the dot plots, they're saying 7 more hikes. Inflation's out there. You got to slow things down a little bit on that front. All the concerns are there, but the initial reaction seems to be taken in stride. Do not forget, though, when you look at the last 7 rate hikes, okay, when the Fed started it, the very first hike, the S&P was higher a year later 6 of those times. So normally when the Fed starts hiking, things can do okay.
Will rate hikes be enough to tamper inflation, and how much more do you expect for the year? I know you had mentioned 7 more hikes according to the dot plots, but it seems like there's a lot under the surface here, Ryan, and it's not just inflation we're dealing with. Of course, we have the war in Ukraine as well, which is going to only, hamper demand and supply chain.
Yeah, we're in the camp, Jill, that there probably won't be 7 more hikes after this. We think maybe more like 3 or 4, so maybe call us a tad more dovish. And the impact of Ukraine and Russia, that is part of it, no doubt about it. Some of the economy has been pulling back a little bit, but Jerome Powell's been very outwardly saying, hey, inflation is a major problem. You have to, but hiking rates is one way to potentially combat that. But don't forget, there's a $9 trillion balance sheet also, and they're going to start running that off, it sounds like, pretty soon. So that's another way that the Fed potentially can combat the inflation, the record inflation, really, that we're seeing. And we think inflation likely will peak sometime over the next couple of months. And then that can be a potential positive as we go forward.
Right, and we just mentioned that it could be tougher to manage inflation on a global basis, partly due to the war in Ukraine and the impact to commodity prices rising dramatically. We all know what happens when cost inputs rise. What do you think the longer term impact of Russia-Ukraine will be, not just from an inflation perspective, but global economy?
Yeah, I mean, put it this way, we don't think the United States is going to go into a recession. But what's happening right now with all of the input prices going up and bread and things like that, the wheat costing so much more, it's going to potentially put Europe into a recession. So the way we're managing our models for our more than 20,000 LPL, or nearly 20,000 LPL advisors, we're saying underweight developed international, stick with the United States. There was a time, 2010, 11, 12, when Europe had some major problems, went into a recession. The United States did not. So we think that potentially could be the scenario once again here.
Right, and you took the question right out of my mouth, asking if you think a recession is possible. So let me take it one step further. Isn't that part of the normal cycle, though?
Mm-hmm. Yeah, well, eventually there's a recession, and sorry for stealing the next question. I'm so excited, apparently. But no, we can dive into this a little bit. Well, you think about it. When you start to see rate hikes, what does that mean? Well, maybe some more normalcy is coming, right? We've taken a look. I mean, you usually don't have a recession for several years after that first rate hike. Now, I understand that we understand the scenario now is a little bit different than maybe some previous times. But every time you start hiking rates, we're nervous. I remember December 2015, right, when we ripped the Band-Aid off, had that first rate hike. What happened? I mean, stocks did sell off initially, but then we had several more years until a 100-year pandemic really kind of upset the apple cart back then. So it is something investors need to remember, that it's not the end of the world when the Fed starts hiking rates. It probably means you're more mid-cycle than anything.
Right, that's a great point that you make. So we have inflation, we have rates, we have a war in Ukraine, supply chain issues. We also have to remember it is a midterm year as well. How do stocks typically react to that?
Yeah, let's talk about a lot of bad news right there. Let's get some maybe good news here. Here it is. Here's the truth. Midterm years, Jill, historically are the most volatile of the 4-year cycle. We were saying this to LPL Research 3 months ago, right before the year started. A 17% average peak to trough correction in a midterm year. So seeing this volatility in a midterm year, not overly exciting. Here's the good, or not overly surprising, I should say. Here's the good news. 1 year later, stocks are up over 30%. No one knows when the true lows are going to be. We're pretty optimistic. We're pretty darn close, to making some major lows here in March, like we did in 2003, 2009, and 2020 in March. And if we're close to that, a year from now, we could be sitting here and, hey, history doesn't repeat, but it rhymes, said Mark Twain. We could have some much higher equity prices, we think, a year from now.
All right, Ryan, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.